So as usual, we'll start with the looking at the economic calendar, because that always determines how you plan your trading day. Today is Wednesday, the 27th of April. And obviously, the main market we're focusing on over the 2 weeks is the Euro-US dollar market. So we're looking for reports that could affect the market we're looking at. We can see here there's a report of high importance DR today, the Euro-German Consumer Price Index. But unfortunately, not the time. That's a bit tricky. I guess you can always Google that and try and find out what time possibly that report will be coming out. But that'll be coming out today sometime. Unfortunately, the time is not there. Then at 8:30 GMT time, which is 9:30 UK time, we have the GDP report from Great Britain. Obviously, that will have more of an impact on the pound dollar and the FTSE than the Euro-US dollar, but it could affect the Euro-US dollar, but not as much as the pound dollar and the FTSE. And then we come down to 4:30, where we have the U.S. Federal Open Market Committee rate decision. So basically, that's just the interest rate decision from America at 4:30. And then and remember that's 4:30 GMT time, so that's 5:30 UK time. Then at 6:15, which is 7:15 UK time, we have the U.S. Fed Bernanke speaking at the Federal Press Conference. So I mean that's more of a press conference. So we're not just sure what he will say or if he will drop a bomb or a weird announcement, but it's not a report per se. It's just that whenever Bernanke speaks, people listen, and if he says anything out of tone, it might affect the markets. But we'll be going with the last report of high importance, which will be the interest rate decisions. That's the major report coming out at 4:30 GMT time, 5:30 UK time. Obviously, we have the New Zealand rate decision at clock, but obviously not have an impact on the Euro-US dollar. And that's it for the rest of the day regarding economic news. So I think the major one, or the last major report of importance, is the interest rate decision from America at 5:30 UK time. And I suspect the Euro-German Consumer Price Index would have been announced prior to that report coming out at 5:30 UK time. So anyway, the good thing is that our plan covers for that anyway, because the plan is to trade extremely cautiously prior to the last report of high importance coming out. And the last report of high importance coming out, it's at 5:30 UK time, which is the U.S. interest rate decision. So if you're an extremely cautious trader, you will just keep out of the market till 5:30 UK time. But according to my trading plan, I will place one cautious trade prior to that last report coming out. And if I get taken into the market and I lose on that first trade, and I'll stop trading till after the last report of high importance. If it's like yesterday where the market takes the order and we're successful, then also we'll stop trading and we won't trade anymore. So that's the plan for today. So we'll be meeting again at 12 midday as usual, but I'll also send another webinar invitation for us to meet at 5:20. So we'll meet 10 minutes before the report comes out at 5:30, and that will be the last session for the day. So session today will be at 5:20 and not 8:30. So we will not be meeting at 8:30 this evening. So the last webinar of today will be at 5:20. So the 8:30 webinar will be cancelled since we meet at 5:20, and we'll be able to round up the day then. Okay, so like I said, with that in mind, we know now how we have to approach. We know we have to approach it with caution, and we're only going to have one attempt at the market prior to 5:30 when the interest rate decision is announced. So with that in mind, we'll go to our charts, look for swing trading opportunities. So as we can see, it's the 1-year daily chart for the Euro-US dollar. The main indicators I use for swing trading are the Fibonacci retracement and the moving average 50. And like I said, I'll be talking about the Fibonacci retracement in detail at the end of this session. So you can see that since the market broke the moving average 50 on the 13th of January, the market has been trending up since then. Always remember, the market never moves in a straight line, pull back, go up, pull back, go up, pull back. Or when it falls, it will fall, rally, fall, rally. So again, the market never goes up in a straight line. It's always interesting where you hear people make commentaries on the market on a day-to-day basis. You know, it's amazing. You know, today they will say something good about the euro. The day it falls, they will say something bad is happening. Then it goes up, they'll say something good is happening. Then it pulls back, they'll say something bad is happening. But once you're used to technical analysis, you find that, look, that's just the normal way the market goes. It goes up and down. It never goes up in a straight line. So we can see here that the moving average 50 has now just about crossed over the Fibonacci retracement. So a potential place to sell if the market starts to fall would be just at the Fibonacci retracement, the 23.6% Fibonacci retracement. So you can sell at that retracement. And funny enough, you can also use the moving average to sell at that same point too. Obviously, that's still quite far away from the market. It's about 400 points away from where the market is now. But that's a potential place to sell if the market falls from a swing trading point of view. And then obviously to buy will be the 0% retracement. So obviously there are no clear swing trading opportunities at the moment. Okay, so we'll go now to day trading. So we'll go down to our 2 days, 5 minutes chart. And of course, we can see quite straightforward. You can see the market trending sideways. So you can see where the market went up and formed the high there. And that's the high of 14,713.5. So just round that up to 14,714. So the market has gone up, made a high there. It's come down, it's made a low there. So the low point there is 14,664. And you can see the market is just trending sideways within that. So again, you always remember the cardinal rule is you don't trade in a sideways trend. And besides, the first thing you always look for when you look at the chart is, to try and identify the trend of the market. Once you're best thing you do is identify the trend, then from there you can then look for where your entry points in the market is in relation to the trend of the market, and that will then determine where you place your trades. So as we can see, we mainly use the pivot points, which I talked about in detail yesterday, and you can watch the recording on that on the YouTube channel if you missed the session yesterday on pivot points. So we can see here that the market is trending sideways. We've marked the high and low of the sideways trend, and we can see that the first resistance and the pivot point is well clear of the sideways trend. So the pending orders we'll place a pending sell order just below the pivot point. The pivot point is at 14,632, so we'll place our pending sell order 30. So we'll have a pending order to sell just below the pivot point, and then we'll have a pending buy order just above the first resistance, and the first resistance level is 14,770, so we'll be buying at 14,772. So that's where we'll have a pending orders. So we'll have a pending buy order just above the first resistance, a pending sell order just below the pivot point, and we'll just keep out of the market in between. So obviously between now and when the interest rate decision is announced at 5:30, if the market continues to go sideways, then fine, we'll keep out of the market. If the market starts to fall, then we'll sell just below the pivot point, or if it starts to go up, we'll buy just above the first resistance. Remember, if the market does move before 4:30, if it takes one of those orders, you make sure you delete the other order, because you only want to have one live trade prior to the report coming out. Because these are not live trades yet, they're just pending orders. So if the market takes one order before 5:30, you delete the other order. If that live trade becomes successful, then fine, you end your trading for the day. But if that live trade is unsuccessful and you lose out on that live trade, then you stop trading and wait till the report is announced at 5:30. Okay, I'll just print that out so I can put down the blog. So any questions on our game plan? To click the hand button or send your question to the through the question box. So if you have any questions on trading in general and what we've done, because like I said, the key is to understand the rationale behind why we're placing the trades, what we're doing, the logic behind the trade. So I always say, if the thing with trading is that if you can rationalize why you're placing the trade, you can understand the pros and cons of what you're doing, and that makes it takes away the stress and the guesswork in trading. I always say, if you can't explain the rationale behind your trades, you can't explain clearly why you've placed the trade you placed, then you're probably just gambling or just taking a pot shot at the market. You always have to be able to explain clearly what you're doing, why you're doing it, because the whole essence of being a good trader is being able to repeat what you're doing on a regular basis and being confident in what you're doing, because you're using the same strategy and same system all the time, so it just becomes second nature. So that's always the key, is understanding the rationale behind what's the way you're placing them. And of course, good money management. Okay, so that's the plan for today. We'll just have a look at option watch list. We did the option screening for stocks last night, so today we'll just look at the stocks we actually have on our watch list to look for trading opportunities. And then after that, we'll talk about Fibonacci retracement. But yeah, obviously, if you have any questions anytime during the session, just go ahead and click the hand button or send your question through the question box. So I'm just going to go through the watch list to look for option trading opportunities. So this is the chart from Option Express. Obviously, the need up, so we're looking for call options. We're looking to place call options on the stocks on our watch list. This is the first one. We can see it's trending up. We already have an option already on that stock. We're just looking for new opportunities. So we're looking for, because the broad market is trending up and we're looking for call opportunities, we're looking for stocks that are trending up. So we're only looking for uptrending stocks, and then if they're uptrending, we're going to see if they're oversold, and that will be shown by this Williams percentage R descending to -80 or greater. So that's what we're looking for. Uptrending stocks, clearly uptrending stocks, and those uptrending stocks to see if they're oversold. Now you can see this is trending sideways, so we just want clearly uptrending stocks. Okay, so you can see that's now beginning to trend up, but we just wait for it to pull back or become oversold. That's trending down. We only want uptrending stocks. That's trending down. That's trending sideways. Like I said, we only want clearly uptrending stocks. That's two is going sideways. That's beginning to go down. Okay, so you can see that's a clearly uptrending stock, but it's not oversold. That's trending down. Again, that's a stock that's clearly uptrending, but is not oversold. Okay, that's now beginning to trend up, but we already have an options trade on that stock. Okay, that's trending up. We're actually going to place an option on that stock, but the value of the stock started to fall, so we didn't place an options trade on that stock and we abandoned it. It's trending sideways. We really want clearly uptrending stocks. Now you can see this is trending up, and then it became oversold yesterday. So you can see here yesterday, just make it bigger. So you can see yesterday it became oversold. And you can see the Williams percentage R there is -96. So that's -96. So that's it's now oversold. So this is an uptrending stock. It's oversold at the close of trading yesterday. We now just have to wait for evidence that the stock is now going back up, and that evidence is for the stock now to close the moving average 7, which is this red line. It has to close above the moving average 7 within 5 working days. So we'll watch that and see. That's going sideways. That's trending up, but we already have an options trade on that stock. That's beginning to go sideways, so we'll just ignore that one. Yeah, you can see that's beginning to trend up now, but it's not oversold. Again, that's trending up, although in a haphazard way, but it's not oversold. That's trending sideways. Okay, that's trending up, but it's not oversold. That's trending up. We already have an options trade on that. That's trending sideways, so just ignore that. We only want clearly uptrending stocks. You can see that shot up and it's going up, but we have to wait for it to pull back. So it's not oversold yet. That's trending sideways. That's trending down. Okay, that's a nice uptrend, but it's not oversold. That's trending up nicely, but it's not oversold. That's trending up nicely too, but it's not oversold. Again, that's trending up nicely, but it's not oversold. Okay, you can see that was trending sideways, but took off yesterday. But we have to wait for it to pull back. It's going sideways. Okay, that's a nice uptrend, but it's not oversold. Okay, and that's trending up nicely, but it's not oversold. That's beginning to go sideways. That's going up in very haphazard fashion, but it's not oversold anyway. That's trending up nicely, but it's not oversold. Okay, that's beginning to trend up too, but it's not oversold. That's trending sideways. That's trending sideways. That's trending up. Well, it's not oversold. We're actually going to place an options trade on this stock, but the open interest was less than 100, so we didn't place an options trade on that stock. So we abandoned it. That's trending up. It's not oversold. And that's a stock we had an options trade on. We had an options trade on this stock. You can see where it became oversold and where it closed above the moving average 7. We placed an options trade on it. The market was going up and we were in a profitable trade, but yesterday the market just gapped down. You can see the huge gap down and took us out of that trade. So we had a loss on that trade. And now it's become oversold again. So I have to start all over again. That's going sideways. And that's trending up. This is one that we've been watching. Just highlight this one again. So you can see here this on the 20th of April. It became oversold. You can see the Williams percentage R of minus 89. So it became oversold on the 20th of April. So from then we're just waiting for it to close above the moving average 7 within 5 working days. So you can see 1, 2, 3. So 3 days have gone by. It still hasn't closed above the moving average 7. So it's still got, and if it hasn't closed above the moving average 7 by then we'll just abandon that trade. So that's one we're watching. Okay, that's a lovely uptrend, but it's not oversold. That's trending up. We already have an options trade on that stock. That's trending up nicely, but it's not oversold. That's trending down. That's trending sideways. Okay, well, you want clearly uptrending stocks. That's going sideways. See, that was going sideways. It's gapped up, so we just have to wait for it to pull back. Okay, that's trending up, but it's not oversold. That's trending up, but it's not oversold. That's trending sideways. That's trending up, but it's, although it's trending up, but it looks like it's now going to start going sideways. Now that's a nice uptrend, but it's not oversold. That's trending up, but it's not oversold. That's trending up, but it's not oversold. That's a beautiful uptrend, but it's not oversold. That's trending sideways. And the last two, that's beginning to go sideways. And the last one, that's going sideways. Okay, so have a look and see later what. So I'll send you out all this, the results of the screening. So now we'll go into the Fibonacci retracement, and like I said, this session has been recorded, so don't worry if you have to leave before the end. Watch it later on the YouTube channel. So let's go to the Fibonacci retracement. So go to the 1-year daily chart. Now, with the Fibonacci retracement, it's a very good way to swing trade, because basically with the Fibonacci retracement, what you tend to do is you trade from one retracement to the next. And it's I love it because it gives you a clear entry point into the market and a clear exit point to the market. So for instance, when the market is falling, you could have sold at that retracement, and then you take your profit at the next retracement. So that will be your entry point, and the next retracement will be your exit point. Same again, when the market was going up here, you could have bought at that retracement, and then you exit at the next retracement. So that will be your entry point, your exit point. Again, you can see where it was falling. You could have sold at that retracement and exited at that one, sold there, exited at that retracement. So basically, that's the beauty of the Fibonacci retracement. It gives you a clear entry point and an exit point. So you trade from one retracement to the next. Again, you can see here where you could have traded from that retracement up to the next retracement. So it gives you a clear entry point in the market and a clear exit point. Obviously, with swing trading, you have to have a lot of patience and wait for clear opportunity and trade in the direction of the trend, because you can see here this is in the direction of the trend. You buy at that retracement and you exit at the next retracement. And obviously it's called swing trading because it takes a while to get to your profit target. So you can see here you could have bought on the 16th of September at that retracement, and you wouldn't have got to the next retracement till the 4th of November. So you can see from September, October, November, almost 2 months before you got to your profit target. But the good thing about swing trading is that you don't have to worry. It's a good way to trade if you're got a busy life, busy at work, or you've got other commitments. So that's the big advantage, is that you just place your trade and you have a long-term target. Like say it could take 2 months to get to that target. But you can see that it's about it's about 1,000 points difference from one retracement to the next. So you'll be capturing 1,000 points too at the same time, but over a couple of months. But the thing about swing trading that you don't get an opportunity every day. But some people see that as a good thing, because if you're not trading, you're not losing money. Because most people lose money because of over trading. So you definitely can't over trade as a swing trader, because the opportunities don't come every day. I mean, for instance, now if you've just started trading today and you just traded, just looking for swing trading opportunities today, like we said this morning, you can see the only place you could trade would be at this Fibonacci retracement, and who knows, the market might take weeks or months to get to that level, or it might take weeks or months to get to that next level. So that's the thing, you just have to wait and be patient. So you don't get an opportunity every day. But the good thing is that you don't have to watch the market too every day. So there are pros and cons to swing trading. But that's the beauty about Fibonacci retracement. It gives you a clear entry and exit points into the market. So the next thing is, how do you draw the retracement? Because obviously you have to draw the retracement yourself. Now, like say, usually when you bring up your chart, this is different trading platforms, and there are different techniques and different systems to different platforms. But for IG Index, you find that if you want to expand, because you can see if you minimize the chart, it only takes you as far as 2007. And usually when you want to draw your retracement for the first time, I always say it's advisable to go as far out as possible and then walk your way from future to get your retracement. And to do that, I've just found that to expand your chart with IG Index, you just have to increase the time frame from 1 year to 30 years. So if you do that, that sort of expands the chart. So when you now drop it back down to 2 years daily and you minimize it, you can see it will now take you all the way back to 30 years. And it's always best to start from as far back as possible when you're drawing your retracement for the first time. So I'll just delete this one. So we're now going to draw it. So you minimize your chart, you go as far back as you can. So you see we've gone as far back as 1980. Now, your Fibonacci retracement icon is at the top of your chart there. Sometimes you might find that and I hope you can see it. Sometimes you might find that your chart will be blank, that you might not see the icons at the top of your chart there. But if you just double click over the chart, it will bring up the icons. So if they're not there, you just double click on the top and that will bring up your icons. So they should be there. To bring up your Fibonacci retracement, you have to click on that icon there where my cursor is. So you click on that once. So make sure you just click once, don't click again, and then just take your cursor to the, because if you click again, it will bring up your retracement. So you have to be careful you don't click, and then if you click again, it sets it. So you have to be very careful when you're drawing the retracement that you just click once, and it's only when you're about to set the Fibonacci in your chart that you then click once again, because it's quite sensitive. Otherwise, you find you're just, drawing the retracement all over your chart if you keep clicking. So that's quite important. Okay, let me just delete all that. Okay. Oops. Okay, so I'm going to start. So I say you left click the icon once and then don't click. You can just move your cursor without clicking. Now to draw your retracement, if the market is trending down, you draw your Fibonacci retracement from the highest point to the lowest point if the market is trending down. If the market is trending up, you draw your Fibonacci retracement from the lowest point to the highest point. So we can see here at the beginning here where the market is trending down. We'll draw the retracement from the highest point. So we'll left click once. So we'll draw from the highest point down to the lowest point, and then you can extend it. But that's the lowest point there, so you just extend it. And then left click once. So once you've set it, you then right click, just so that you don't keep drawing on the charts. So you can see that's how you draw it. So it's downtrend and you draw it from the highest point down to the lowest point. If you want to make the lines bolder or change the color, you just right click on the retracement. you select configure, and you can change the width, you can change the color, and you can also extend the, if you want to extend it all the way to the future, you can just click on extension, and that extends the line. Now, once you've drawn your Fibonacci retracement, you can keep using this retracement indefinitely until the 0% is broken or the 61.8% retracement is broken. That's the 61.8 retracement there. So once the 0% is broken or the 61.8% retracement is broken, then this retracement becomes invalid and you have to redraw it. So as we can see here in this example, the market was downtrending, so you can keep using it, but once it breaks it here on the upside, when it breaks the 61.8% retracement here on the upside, it now confirms the market is now trending up. So now you now have to delete this retracement and now draw the retracement from the lowest point to the highest point. Because when it breaks it on the upside, it just confirms the market is now trending up, so it's no longer trending down. So remember, once the 61.8% retracement is broken or the 0% is broken, the retracement becomes invalid. So now that it's broken here, we now have to redraw it. So we'll right-click, delete. So we're now going to draw from the lowest point to the highest point. And there we go. Then we'll just right-click. And then right-click to configure it, just make it bolder. Now, you can see now that we've got a new retracement. Again, we can keep on using this retracement to trade. But you can see here it's broken the retracement on the downside. So it's broken it at the 61.8% retracement there on the downside. So this is now a downtrending market. So now we now have to draw from the highest point to the lowest point. So again, remember, once the 0% gets broken or the 61.8% gets broken, you have to redraw the retracement. So now that it's broken it on the downside this time, it's now a downtrending market. So we draw from the highest point to the lowest point. So we delete that. Again, left click, go to our cursor, just left click once at the highest point and drag down to the lowest point. And then left click once. Now, if you don't right click, what will happen is that anytime you use your cursor, it will keep drawing the retracement. So that's why you have to right click so that the cursor goes back to the default setting, and you don't. So then you can just click on the chart without redrawing the retracement all the time. So that's why once you set the retracement, you have to right click so you don't have to keep drawing the retracement on your chart. Okay, so now we've got this downtrending retracement. I'll just quickly configure it again, make it bold so you can all see it clearly. So again, you can see we've drawn it from the highest point to the lowest point. Now it's gone back up. Again, you can see here clearly where it's broken the 61.8% retracement, so that this is no longer valid. So now we now have to draw from the lowest point to the highest point. So again, we'll left click, draw from the lowest point to the highest point, and then right click so we don't have to keep drawing on our chart. Now that we've come to the most recent period, if you want to make your retracement more accurate, we're just going to expand the chart. Or what you can just do is go to the default setting, make it big. If you just click anywhere in your chart, you can drag it. So if you just click anywhere, you can drag, click, hold, and drag your chart. Oops. I just want to get to the lowest point, so you just click, hold, and drag it. So you can see that's the lowest point there. But we want to make it accurate, so we'll put our cursor over that candlestick. We can see that the low there is 8231. So you right-click on the retracement and then change it to 8231. 8231. Again, you can change the width and the color if you want. And again, we'll select the extension, so we extend it into the to keep redrawing it, and then close. So that way we know that we've got it exactly at the lowest point of the market. Then to get to your default setting of the chart, you click on that. Now we'll do the highest. So that's the highest point there. So that's the highest point there. So the high there is 16038, round that up to 16039. So right click, configure 16039. Close. And there you go. And there you have it. That's your retracement. So now we're back to present day. So that's the retracement at exactly the lowest point, exactly the highest point. And you can just use this to trade now. So like I said, you can carry on using this retracement until the 61.8% retracement is broken or the 0% retracement is broken. So for instance, if something happens in the Eurozone and the market starts to fall, you can trade, sell there, exit there, sell there, exit there, exit there. Obviously, once it breaks the 61.8% retracement, you have to redraw it. And like we've been using this retracement because obviously since the market made that low and high, it made the high there in July 2008. So since July 2008, I've been able to use this retracement since that point. So since July 2008, you can trade from that retracement to that, trade from there to there, from there to there, from there to there, from there to there. And now we've got another buy order there. Let me show you that. So that's another current trade I have on there, and you can see we're making 411 points so far from that swing trade. Okay, so that's the beauty of swing trading. You can just keep going. You're going from one retracement to the next. Okay, any questions? So like I said, this recording will be on the blog, so you can practice drawing your retracement. Oh, before I forget, once you've drawn your retracement and you've set it, you have to remember to save it. And to the advanced chart box, click on File, and then click on Save. Because then once you've saved it, then you don't have to redraw it again. Because as you can see in the example I've done here, I've saved mine, so anytime I bring my charts up, I don't have to redraw it. And it's extended way into the future. That's why you do the extension. So, that's 2020. So it's gone all the way. It just keeps extending on and on. So I don't have to redraw this retracement again. I've saved it, and I'll just keep using it until the 61.8% retracement is broken or the 0% retracement is broken. So yes, remember to save it. Brilliant. So if there are no questions,